Hello, welcome to the first video in the Bluff City Finance Academy. This is lesson one, Intro to Finance by me, John Potter. All of these PowerPoints are posted in Discord already. We just wanted to explain them in more detail for you guys. So yeah, let's get into it. What is finance? Finance is the study and system of money, investments, and other financial instruments. So this is the most basic definition of finance. Um, Money, we all know, it can be physical, currency, and coins. There can also be electronic forms of money. Investments, these can be in forms of stocks and bonds, real estate, commodities like oil and gold, and then also mutual funds and ETFs, which we'll get into later. Finance also involves the use of credit and debt, which is not seen anywhere else. Securities and investment to finance projects using future income flows. So that just means whenever you invest in a company, you expect to get money in return for that to fund a project. So why is finance important? So finance involves borrowing and lending, investing, raising capital, and selling and trading securities. So it's pretty self-explanatory. Basically, when people put money into something, they expect to gain something in exchange for that money. Um, these concepts allow money and or allow companies and individuals to fund certain activities or projects today to be repaid in the future based on the money generated from those activities. So they just expect they put money into something, they expect money to come back, or they expect something in return. It doesn't always have to be money, it can be something they bought or something. So the main goal of finance is to maximize profits, though. That is the main goal. These are some key terms before we get into the main stuff. So, first one is asset, which is something of value, such as cash, real estate, or property. You'll see this term a lot in finance classes, or it basically just means anything of value. Balance sheet and cash flow are two documents that will finance or cash flow says movement of money in and out of business, which is obviously true, but it's also a financial statement. So balance sheets and cash flows can be are two of the three financial statements we will learn about in this program. But there's a basic definition for you. Interest is the price you pay to borrow money or the return earned on investment. So you can either make interest, for example, say in a retirement account when you put in $10,000 when you're 18 and it goes up to a million by the time you're 60. You're making interest over that period of time. But interest can also be bad. You can also be losing money because of high interest rates. So it can, for example, a loan or a car payment. Those can be taking money from you the longer you take to pay back the loan. So yeah. And the next one is equity, um, which is percentage ownership in a company. Each share represents a portion of ownership. So this is just percentage you own of the company. So an investor makes that percentage of money back when the company makes money. So my example I like to use is in Shark Tank when they say I want 5% of your company and I'll give you $100,000 for it. So they're giving the company $100,000, putting $100,000 of their own money in, and they're getting 5% of the company. So say that company makes $20 million, they'll make 5% of that, which is a million back. The next one is liability. Pretty self-explanatory. It's just a financial obligation such as debt. Liquidity, how easily an asset can be converted to cash. So cash is the most liquid asset because it's real, it's there. You can hand it to someone, it's theirs. It's very liquid. Real estate is the most non-liquid asset, so it takes the longest to say reach the buyer to the seller or the buyer to the customer. Um, Profit is obviously everyone knows profit is the money left over after expenses, not to be confused with revenue, which is the amount of money that a company totally makes. Profit is just the money left over after expenses um, for the company. I want to include share also, which you'll see this come up a lot, um, is a unit of ownership in a company. So, say you're investing in stocks and you buy 5 shares of it. Um, that would be a unit of an ownership in the company. So a share might cost $10. You buy 5 shares, it's $50 put into the company. So next are categories. So the three most common categories, or the three common categories of finance include public finance, corporate finance, and personal finance. So public finance mainly just involves the government or federal and state governments controlling an amount of money. So here it says allocation of resources, distribution of income, so paying people who work for the government, stabilization of economy. And this is all funded by taxation, so that's where this money is coming from. Next is corporate, which focuses on how corporations or basically any legal business or company that has investors. Um, this how these businesses use the money invested. So you're putting in $100,000 to that business. What are they doing with that money? What are they actually using it for? Next is personal finance, which is just how we as normal people spend our money every day. So we pay our bills or something like that. Next, I wanted to go into subcategories a little bit. These are a little less common and will come up a lot less, but these one include social and behavioral finance, which I find pretty interesting. Social is usually funding to support social issues or promote sustainability. Um, so investments made in social enterprises. Um, Philanthropy is another good example for a social example of social finance. Um, and then behavioral, which proposes psychology-based theories to explain financial anomalies. So this one's really interesting to me. It's basically the psychology and understanding why people invest, why people spend money, and why we make decisions, etc. So yeah. Next is financial markets. So the most common one is the stock market. Everyone's probably heard of that. Nowadays, almost anyone can invest in the stock market. It's a really open um, place to invest. Popular stock markets include the New York Stock Exchange and Nasdaq. Um, Currently, the best stock in the world is Nvidia, with an 800% increase in the last 18 months. So, yeah, just a basic definition: trades shares of ownership of public companies. Each share comes with a price, and investors make money with the stocks when they perform well in the market. So, investing in companies that you think will boom and go really high is good for you, obviously. Next is the bond market. Offers opportunities for companies and the government to secure money to finance a project. So bonds are a loan. Um, this is the difference between bonds and stocks. So stocks give you a percentage of a company, whereas bonds let you loan a company or the government money. So you're taking money out and putting it into the company or putting it into the government as a loan. So investors buy bonds from a company, and the company returns the amount of the bonds with an agreed period. Yeah. Lastly is the commodities market, which is a lot smaller, and it's where traders and investors buy and sell natural resources such as oil, corn, meat, and gold, like I mentioned earlier. So yeah. Next is financial instruments. Um, any asset. So a financial instrument is any asset which holds value and can be traded in the market. So the most popular examples of these are stocks, ETFs, mutual funds, and there's many others I could get into. Can be real or virtual documents representing a legal agreement involving any kind of value. So these can be electronic, um, physical. Yeah, we just call all these forms of we just call financial instruments all forms of capital and value. So next is risk management, which is a bit of a more specific topic in finance. But it's the process of identifying, assessing, and controlling financial risks to capital and earnings. So low risk obviously benefits the buyer, high risk um, does the opposite. It will not benefit the buyer. So if you're investing in a stock, um, that has a low risk. You're probably not going to gain much if the company does well, but you also won't lose a lot if the company does bad. With high risk, that is completely flipped. So these risks can stem because of financial uncertainty, legal liabilities, or natural disasters. And there's many other reasons why people would invest in some way they do. Like um, insurance and diversification are the two most common strategies to avoid risk. So insurance is people use insurance to avoid risk, um, and this is called a risk transfer. You pay a premium, and the buyer can protect themselves against large losses. I mean, we've all heard of car insurance and health insurance, which you pay a premium each month, and you're protected for that month or however long you pay it. So you would pay less if something did happen to you, which is the same with insurance in like the markets. Next is diversification, which this a basic definition is spreading investments across many different assets or stocks. This reduces exposure to any single risk. So say one stock it plummeted and went really bad. You would have a diverse portfolio to bring that back up and minimize the losses. Um, so yeah. Um, Next, I wanted to go into the difference between finance and economics because I feel like when I was first learning about finance, I didn't understand this, and I always wanted to be someone to explain this to me. So simply put, finance is the focus of on more like an individual or a company or an industry specific issue. Um, Economics tends to be bigger picture in nature, such as how a country or region is performing. So finance example, a specific company like Apple, how is that affecting us? How is that affecting the government, and how is that affecting that? And then an economics example is how the economy of Japan. What is Japan's economy doing right now? Which is just all the markets combined. Is it going up? Is it going down? Something like that. Um, Lastly, I wanted to go over the careers in finance. Right now, a finance degree is very versatile and can be used for many different jobs. These are just a few I've listed. The first two, accountant and auditor, are focused more on accounting, and accounting degrees would be better for these, but you could still break into finance with a finance degree because it has such a wide range of variability. But yes, um, banking is also a huge part of finance. It's a huge sector. You can be a commercial banker or an investment banker. They have different jobs. Um, you can go into any one of these further if you wanted to, and look at the salaries and look at everything about these. But these are just the most basic careers in finance that I wanted to just let y'all know about. And thank you. That is the first lesson done. Hope you guys enjoyed, and I'll see you in the next video.